Okay, so picking back up with learning objective 4, where we're going to look at the different pieces of the auditor's audit report. Okay, and the learning objective has public and non-public. I'm just going to focus on the public ones. Those are the large companies but more than that, there's just a lot of similarity between the two, and to me it's not worthwhile to kind of do both of them. So I'm just going to focus on the public, even though the non-public ones are still in the slide deck. All right, so if you look here at the, this is kind of an overview of the standard report. And so I just want to hit a couple of things that we're not going to hit in some of the later slides. The title usually has something around registered or independent public accountant, report of the registered independent public accountant. I've seen it's addressed to the shareholders and the board. Obviously it's going to be referring to PCAOB, which we'll see in a minute. We'll talk about the responsibilities in a minute. We'll talk about the different paragraphs, and we'll talk about some of the new things here is you have to now disclose what year did you start serving as the auditor. So now you can see a tenure of the auditor. So for example, Deloitte audits Lowe's, and they've been their auditor since, I think it said 1962. Right, so that's a pretty long time that they've been their auditor, really long-standing auditor. When you sign the opinion, it's the CPA firm, not the individual partner, even though there's been a push to get individual partners' names on there. At least in the U.S., they've resisted that. Other places throughout the world, they've required individual partners to sign, but in the U.S., they've resisted that. And you'll see the city as well, and then they'll date it. Okay, so let's though look at some example paragraphs. All right, so we'll start. They always start off with the opinion paragraph. It says they audited, in this case, the balance sheet and related statements of income, comprehensive income, shareholders' equity, cash flow, and then there's that piece about, for the 3 years and the period ended. That's the comparative dates, and it also covers the notes. And then kind of the bottom line here. This is, and we'll talk about opinions later in terms of what different kinds of opinions. This is considered a clean opinion or unqualified. In our opinion, the financial statements present fairly in all material respects. Right, the financial position. That's a real thick line there. And results of its operations, right? In conformity with GAAP, accounting principles generally accepted in the U.S. That's another way to say GAAP. Okay. It says we've also audited. In this case, they've also audited the internal controls over financial reporting. Okay. And this is well, I say relatively new. It's not as new now as it used to be. But they also provide an opinion over internal controls, and are also expressing an unqualified opinion. Unqualified means we don't have any reservations. Everything looks fine. Okay? So that's the opinion paragraph or paragraphs in this case. And so that kind of gets you to your bottom line right away. So then the next section is called the basis for the opinion, and that's basically how did the auditors basically come to this conclusion, right? And so it kind of starts off with those responsibility statements, right? Managers are responsible for the actual financial statements. Our responsibility is to express an opinion, right? So it's not our job to create them. Our job is just to give an opinion on them. It kind of tells a little bit about the PCAOB, how they're registered, and then kind of this is how we got there. We conduct our audits in accordance with the standards of the PCAOB. There's that bit about we're trying to get to reasonable assurance about misstatements, and then we have a whole set of risks that they're going to kind of talk about and procedures. And so this is kind of like the big how paragraph of how they got to their opinion, right? How do we come up with thinking that everything fairly reflects the financial position and results of the operations of the firm. Okay, but even this is still fairly generic, right? It's fairly high level, and so, but it's just trying to give, especially individual investors, a sense of what goes into an audit. Okay, so this next section is called the critical audit matters. Basically, what this is an opportunity for the auditors to kind of spell out more of what's happening or what happened throughout the audit. Where are the difficult areas? So they're basically saying these are the issues that had to be communicated to the audit committee, and they're material, right? They're significant to the financial statements. They could make a difference in how you make decisions using the information, and they involve challenging, subjective, or complex judgments. Right? Areas where reasonable people could disagree, right? And they're saying, look, it doesn't change our opinion, but we're basically trying to let you know of some of the areas that are especially difficult to audit in this kind of a company, in this particular company. So what's the whole point here? The point is we're trying to take what in the past was kind of a 0-1, you failed or you passed. That's terrible F and a P, but you get the idea. You could fail or pass in audit, and that's all that the auditors could communicate. They fairly represent what's going on or they don't. And there's a little bit of exception to that, which we'll talk about, but it wasn't super detailed. And now what they're trying to do is give a range, a little bit more of a range, because remember, what is the point of the audit? It's to reduce information asymmetry, right? From our market for lemons example, we want to reduce information asymmetry between managers and users of the financial statements. And so the auditors have a lot more, when they're spending a lot of time in the client, they're spending a lot of time collecting evidence, they have a lot more information than the users do, right? And so this is an attempt to try and get the auditors to communicate more of that information, more of that inside information to the users of the financial statements, okay? And so we can look and we'll be able to see this being more and more of an issue, or more and more prevalent as time goes on, where all firms eventually will have to discuss the critical audit matters for the audit. And again, this is for publicly traded companies. Okay, so skipping on past the non-public, on to the next learning objective 5, discuss the other types of reports that are issued by auditors. Okay, so the one that we just saw an example of was an unmodified or an unqualified audit opinion. Everything looks good. We don't have to put any qualification on it. We think that the financial statements adhere to GAAP, and we feel like there's no problems. Well, how can that be? How can we modify that, right? Or how can we change that opinion? Well, we might still think everything looks good, but we might want to emphasize some issue that we think the users need to know about. So, for example, if there's a change in accounting principles, right, that's kind of an important thing for users to recognize, because they try and compare income from one period to the next, but they're using different accounting methods. Well, then those numbers aren't going to be comparable, right? So you're going to have to consider, the users will have to consider how they need to use the information that's in the financial statements. So that's one thing we can do. Another thing is looking at actually qualifying the opinion, and that's where we're going to do that for a couple different reasons. It could be because our audit has been limited. So for example, we got to look at everything except for this department or this subsidiary of the company, right? So everything looks good except for this one area where we couldn't get into. Now, that can't be a really large area in order for it to be a qualified opinion, but it could be an area. The other thing is there's actually a departure from GAAP, right? So we don't agree with the way they dealt with a given type of transaction, right? Like the way that they handled unearned revenue, we disagree with, right? So again, if it's not too material, we can consider that a qualified opinion. So everything is good except for this one area. And we'll get into that more when we get to the reports at the very end of class. This is kind of just a little preview. Adverse opinions are when we have a really large departure from GAAP, and so the financial statements are misleading. And lastly, as a disclaimer, because we have a very significant scope limitation. So there's a really large part of the company that we can't get access to. Okay, so those are some other types of reports we have that auditors can issue. Now they're not very common because the market's going to react poorly, especially to these last three, right? And so because of that, usually there's negotiation between the auditors and the managers to try and resolve the issue before the auditors have to issue an opinion. All right, so the next learning objective is the nature of these attestation standards, which are lower. These are kind of the statements on standards for attestation services. This is such a low priority, I'm not even going to go over it in the video lecture. All right, the next one, learning objective 7, describe the quality control standards and their purposes. And so there's a lot here, but I think I'll just kind of hit each of these here on the summary slide, and you can go to the following slides if you want more information around the different elements. Okay, so there's 6 elements, and so we can look at these in more detail, but I'll just hit them here first. So leadership responsibilities for quality within the firm, right? Tone at the top, you've probably heard that phrase before. So internal culture, and this is of audit firms, right? This is quality control standards that audit firms have. So what kind of leadership and what kind of culture have they set up to make sure that they're actually going to provide quality audits, right? So, is that one of the things that gets kind of trumpeted from leadership, is that we're all about making sure we have quality audits. There's also another element of quality control is, the ethical requirements that they have. There's different code of conducts that the CPAs have to follow, and so the firm is going to have to go out and make sure that all of their employees are meeting all those ethical requirements, especially related to independence. We'll talk about more of that later, but that's a really big one. The third element is related to acceptance and continuation of clients and engagements. So do they have good procedures in place to make sure that they're bidding on clients that are going to be good for the company? So as an auditor, am I taking on clients that have a lot of risk that there's going to be material misstatements, or do I have a process in place to make sure that I'm kind of filtering out those really high risk clients and only taking the ones that we think are reasonable, that meet our requirements for acceptable amount of risk? Same thing for continuation. Do we have a process? Does the audit firm have a process in place to make sure that is a decision that's being made and being considered, especially when we're evaluating, okay, has the audit risk of this client changed, the business risk changed, in terms of it no longer being worth the amount of compensation we get from it. So that's part of quality control for an audit firm. Fourth is human resources, making sure that we get employees that have basically the skills to make sure that they're competent. Right? Remember I said competence is one of the big pieces to make sure we get a good audit. So are we hiring the right people and retaining them to make sure that we're meeting the requirements needed to deliver high quality audits? The fifth quality control element is around engagement performance. So making sure that those engagements are actually conducted according to the standards. So that is there a process in place that kind of either make sure during the engagement that everything's being followed, and after the engagement reviewing to make sure that everything is being followed according to the auditing standards, right? And then quality control element number 6 is monitoring. So this is basically, do firms have policies and procedures in place to make sure that all these other elements are working as they're supposed to, right? So those are the different elements for the quality control, having a good quality control in an audit firm. So I'm going to go ahead and skip ahead to the next piece, and you can look at those detail slides if you'd like for more information. Okay, so picking back up here with the quality control procedures, obviously the amount of those procedures depends on the size of the firm, how many offices you have, is the firm engaged in one state, multiple states, one country, multiple countries, right? Those are going to have to vary. The extent of quality control needed is going to have to vary with those factors. But even small firms should have quality control procedures that are in place, right? So that's important. All right, so regulation. We've talked about the PCAOB before, and we kind of hinted at this. All audit firms that want to audit publicly traded companies have to register, and then the PCAOB comes in and does inspections to make sure that those accounting firms are following the audit standards. For non-public companies, the AICPA has a peer review system where other auditors will come in and look at the non-public audits and make sure that those are following the AICPA standards. And even the State Board of Accountancy has procedures in place to make sure that their licensing requirements and their code of conduct are being followed. So the peer reviews, they're done by other CPA firms. You can do a system review that's kind of more looking at the quality control process, or you can have engagement reviews that are actually looking at the opinions and making sure that those opinions, obviously it's a sample, that those opinions are backed up by sufficient evidence, right? And so they're not quite as extensive as the system review. And you can have these 3 different levels: pass with some issues, or fail. Okay. So again, this is for AICPA non-public audits. The PCAOB comes in and does their own inspections. They're using a risk-based approach to basically select which engagements at an audit firm they want to look at. They also rotate how often audit firms are actually audited. Like the Big Four are audited every year, right? But other audit firms may only be audited once every 3 years. So they're using a risk-based approach to figure out which engagements and which firms to look at. They're focused on the quality control and management issues for those. And they have a written report, and part of that is actually made public. And there's been some research around this that's kind of interesting. But part of it is not public, and so not all the information around these inspections can users see. And then just lastly, a quick point about international auditing standards. They're developed by the International Accounting Standards Board for foreign companies that issue securities in the U.S., right? Foreign-based international companies whose headquarters are outside the U.S. That issue securities in U.S. stock markets. The SEC accepts financial statements that are written based on the IFRS, International Financial Reporting Standards, and there are audit standards, and the point of that is to make sure that there's one set of high-quality accounting standards that are used globally. The international audit standards are trying to do the same thing, but they have much less adoption, I think, than IFRS does for accounting. So international audit reports are pretty similar. They have a little bit different language. They were the first ones, though, to do this key audit matters, which is essentially the critical audit matters. They had that first internationally, and the U.S. actually adopted that after the international audit standards. All right? Okay, so that's it for that learning objective and for the chapter.